Hello and welcome to the webinar Game Changer, the new streamlined domestic offshore procedures. My name is Vinay Navani. I'm a shareholder at Wilkin Guttenplan, a CPA firm in East Brunswick, New Jersey. Joining me on the presentation will be Parag Patel, tax attorney with the Patel Law Firm based in New Jersey as well. The IRS announced this new program last week, and it is of great interest to many people who practice in this area, so we thought it would be good to share with you what Parag and I have been able to put together on this topic. Before we get started, let's just talk about a few housekeeping items. Many of you who are signed up and have requested New Jersey sort of continuing professional education. In that case, it is very important that you answer all polling questions. After the webinar, you'll receive an evaluation form by email. You need to complete the evaluation form, and then the CPE certificates will be sent to you via email. So again, it's very important to answer all the polling questions, otherwise we cannot issue you CPE. During the presentation, if you have questions, there's a question dashboard space on your screen. Please enter your questions there, and if we can't answer it during the webinar, Parag or I will get back to you afterwards. And at some point, assuming that we don't mess up too badly, the webinar will be recorded and uploaded on our website at the address you see on the screen. So let me just give a little bit of background. So June 18th, the IRS announced an entirely new program called the Streamlined Filing Compliance Offshore Procedures. And it was really in reaction to the Offshore Voluntary Disclosure Program, which was criticized as a one-size-fits-all that had some pretty harsh penalties for those who had not complied with their U.S. tax filing obligation. So this is a brand new program. There is a lot of unknowns. There are a lot of things the IRS has not addressed yet, a lot of fact patterns. So I just want to caution everybody to not take what we say, Parag and I say today, as written in stone or concrete, because it is very possible the IRS will be clarifying a lot of the things. All the information for this program is available on the IRS website at irs.gov. The best place is if you look at the link on the front page of the website. It's called Changes to Offshore Income Programs. It'll take you right to these rules, and it is an evolving area. So with that, I'm going to turn it over to Parag, who is going to start talking about the new structure.
Good morning, everyone. We see these changes as game changers because this is what the IRS has done is essentially led to a major change in the climate of offshore disclosures. What I mean by that is that, like any climate change, the temperature has increased, and it's made it much more unbearable for people to have offshore assets which are non-compliant. The new options that are available we're going to be talking about 4 options, spending a lot of time on one option. The OVDP program, the Offshore Voluntary Disclosure Program, there have been new changes announced 9 days ago. And then there's the Streamlined Filing Compliance Procedures, which are bifurcated between the Streamlined Domestic Offshore Procedures, abbreviated SDOP, and the Streamlined Foreign Offshore Procedures, SFOP. Then we're talking about later in the program the Delinquent FBAR submission procedures and then the Delinquent International Information Return submission procedures. We spend most of our time with the Streamlined today. Just in terms of background, any offshore income and filing information for taxpayers who have offshore assets, if you're a U.S. citizen, resident alien, or certain non-residents, are required to be reported. I think we all know that, and unfortunately many taxpayers don't do that, so they're not filing their worldwide income. They're not filing a Form 8938, which is required in most instances, as well as a Form 114, formerly known as FBAR. And because of the non-compliance, that's why the IRS has announced these procedures, and that's why there's been so much interest. Over the past 5 years now, 2009, 2011, 2012, the IRS has collectively received more than 45,000 voluntary disclosures from individuals and have paid about $6.5 billion in back taxes, interest, and penalties. This is, I believe, much larger than the IRS expected in terms of magnitude of disclosures as well as the tax revenue collected. Now, frankly, I think the reason why these streamlined procedures have come into effect is because of this large volume and it's probable that the IRS did not have the infrastructure to handle many OVDP applications, many of which were non-willful, and as a result of that, the IRS has now brought in these streamlined procedures. So let's talk about the environment before June 18th. There was the OVDP program, which required 8 years of amended income tax returns and had a large penalty of 27.5% penalty, the highest account balances over that 8-year period. There are many people that filed for the OVDP. And then there are also many people that filed for the OVDP and then opted out, which resulted in often a much lower penalty upon a demonstration of non-willfulness, or in some cases a zero penalty. And then, of course, you had many people that filed not applied disclosures or silent disclosures, where you're just filing amended returns for some years and delinquent FBARs and hoping for the best. The IRS is aware of all these quiet disclosures, and perhaps that's why they announced these streamlined filing compliance procedures. Now, the streamlined filing compliance procedures, in summary, if a taxpayer can certify that the failure was to file and to pay tax was non-willful, then you have to only amend 3 years' worth of tax returns, file the applicable number of FBARs, in this case up to 6 years' worth, pay a 5% miscellaneous offshore penalty, which is based on assets over that applicable 3-year period, 3 or 6 year period. The only thing is that, unlike the OVDP program, you're not getting an IRS closing letter. The IRS also indicates that the returns may not be audited, are not subject to automatic audit. They may be audited just like any other amended return. But of course, some clients want a closing letter. Some clients are not, can't risk the audit lottery, and that's really what leads to a lot of complexity. It makes our job difficult because we need to ascertain whether a client is appropriate, eligible for the streamlined filing compliance procedures, and if so, how to demonstrate that non-willfulness. At the IRS website, they talk about the eligibility criteria. Now, if you fail to meet the applicable non-residency requirement, in this case for joint filers, in that case, you can file for the domestic offshore procedure. Now, again, there's 2 procedures here in the streamline. One's domestic and one is foreign, abbreviated SDOP and SFOP. The SDOP eligibility requirement is a little bit odd because you need to not satisfy the foreign offshore procedure, the SFOP, which is the non-residency requirement. So you need to look at the SFOP eligibility requirement to find out whether you're in the SDOP.
And Parag,
so again,
let me interject there. When we say foreign and domestic, here we're talking about where the taxpayer lives. All the income in these cases is usually non-U.S. income, but if somebody really lives and their true home is outside the U.S., then they're going to be in the foreign program. If their true home is in the U.S., then they're going to be in the domestic program, which is what you're talking about.
Exactly. And we're going to go through these residency requirements in a moment. But very generally speaking, if you're a resident of the United States, having a home here in the United States, and are a true U.S. person, then you probably qualify for the SDOP. And if you're truly abroad, we'll discuss that in a moment, if you're truly abroad and living abroad, you probably satisfy the SFOP requirements. Now, you also, to be in the SDOP, you also must have previously filed a U.S. tax return for each of the most recent 3 years for which the U.S. tax return due date has passed. And that means that if you're a non-filer, then you're not eligible if you haven't filed. You can't file new returns. You can only file amended returns in the SDOP, which is a key distinction. Now, you also have to fail to report gross income from foreign financial assets and have failed to pay tax as required. And you also may have failed to file FBARs or any of these information returns, such as 3520s, 3528s, 5471s, and a whole multitude of these information returns with respect to the foreign financial asset, which basically got you in this place. That's the reason why you're here in the whole first place if your taxpayer hasn't paid the tax and reported what they had to report. And the most important part is that the failure resulted from non-willful conduct. Now, frankly, all of my clients think they're non-willful, but we have to go through and ascertain whether there's evidence of willfulness or non-willfulness. And the definition according to the IRS, of course, is the non-willful conduct is conduct due to negligence, inadvertence, mistake, or conduct that is a result of good faith misunderstanding of the requirements of the law. And actually, this is specifically what what your taxpayer has to sign. You need to sign a long statement telling that you're not willful. Some clients may be very comfortable signing that statement. Some clients may not.
And Parag, we're going to talk about this more during the presentation, but this is such an important point when you contrast it to the OVDP, because in OVDP you don't have this explicit representation that the client has to make. You don't really get into this issue about willfulness or non-willfulness when you're going into OVDP.
Exactly. You don't have to touch this at all. Now, the only thing is that if you OVDP and then opt out, that's the only instance where you may have entertained this type of discussion and demonstration of non-willfulness. Otherwise, you never had to really dance this dance ever before.
And with that, let's go to our first polling question. Who is required to pay U.S. tax on worldwide income? A, only U.S. citizens, neither U.S. citizens or permanent residents, both U.S. citizens and permanent residents, only permanent residents, not U.S. citizens. Can we take a look and see the screen to let us see the responses so we can figure out when to move on? So if you don't mind, please go ahead and answer that. Are we able to tell how many people have responded? Okay, can we tell real time? Okay, so if you haven't answered your question, please go ahead and answer it now because we're going to move on. And the right answer is C, and actually the answer is more broad than C. You can be here on a temporary visa and subject to worldwide income, but just for purposes of this question, C is the most correct answer. So, Parag, you want to continue?
Hey, going back to the SDOP. Now, very generally, you have to basically create a package for the IRS, almost like a gift, with a nice bow on it, which is this certification. So you have to complete this non-willful certification, which, in my opinion, is the hardest part. What you also have to attach are the amended income tax returns, including all of the required information returns for the most recent 3 years, in which the deadline is passed. And you have to put special markings. The IRS is extremely specific with respect to the in red ink, amended return, subject to the streamlined processing procedure. So I encourage you to look at the IRS pronouncements on this topic and prepare the amended returns accordingly, specific to the IRS's notations. So the next thing is that you also have to pay the tax and the interest, and you have to electronically file complete, accurate FBARs for any of the past 6 years.
And the tax that you're paying also includes the 5% miscellaneous offshore penalty in this case.
Exactly. And what's interesting to note is that you have to not only include this penalty, but you don't have to include the 20% accuracy-related penalty. So in the OVDP program, to analogize for a moment, you had to pay the 20% on the tax due. Now the IRS has aggregated all of these penalties together, including the 20% accuracy penalty, and just said, all right, let's just pay the 5% miscellaneous offshore penalty instead. And just to make our job harder, what they said is that you're not paying it on the FBAR balances notated in the FBAR, which is highest maximum balance across the year. You're actually doing the highest year-end account balance for any asset that would have been reported on your FBAR or on the 8938. So basically, these non-compliant assets. You're doing a highest year-end balance for either the 6-year period or the 3-year period as required in your situation. So you need to have basically a separate spreadsheet. And the IRS does provide a chart. Now, in my office, we're probably going to be putting these on Excel spreadsheets, but you need to put together the maximum balance and apply the maximum balance with each year-end. The maximum balance is the year-end balance over the applicable 6 or 3-year period. It's a little bit different than the OVDP program.
Move on, Parag. I'm sorry, am I a slide ahead of you, Parag?
You have to go to the next slide, Vinay.
Okay.
Now, the most important part and where our value is added the most in this process, the certification procedure. Now, the taxpayer waives all defenses and restrictions on assessment collection on the 5% offshore, as well as any defenses with respect to expiration of any periods and limitations on collection. You waive your right to seek a refund on that penalty. And you also agree to maintain all your records related to the asset subject to this 5% penalty. That's very important because, remember, the IRS you agree to provide these records, and if your records provide details are very complicated, have lots of transactions related to other accounts, or make it hard to decipher, just be aware of that, because the IRS may call you on it and ask you to produce those records, which are telling you that the taxpayer agrees to provide it here. And just be aware that your disclosure not only has to be complete and accurate, but you might have to, you need to review these transaction records that you're going to use to support the package that you're providing to the IRS. Now, the most important part is the specific reasons to demonstrate non-willfulness. This is mandatory. The taxpayer must provide specific reasons for your failure to report the income and submit all these required returns. And if you had a professional advisor, like a broker or an accountant or a lawyer, you need to provide a name, address, and telephone number of the advisor, as well as the advice that was provided. Now, this requires some careful drafting. You don't want to provide too much, but you want to provide enough. You don't want to give information that's going to put your client into more hot water, but you want to provide enough to demonstrate persuasively and a compelling argument for non-willfulness. You want to give them enough information so you basically scare them away if they decide, well, they're probably going to review this. Not going to automatically audit this, but they're probably going to look at it. And you don't want to be that test case where you don't provide any information and there's large balances, or there's evidence of possible willfulness. But you have to be very careful because you have to provide something. And this is the part that we're going to have to all struggle with as advisors, is because you want to provide enough, but not too much, and you want to be persuasive and compelling in your demonstration of non-willfulness for your client. If you're married, you also have to submit a joint certification. And so different reasons to provide those different reasons and provide a statement, what they call separately, and a statement of fact. So they're really looking for factual demonstration here. Again, this is not mandatory. This is not optional. This is mandatory. So can't leave it blank according to this. Now, no one knows exactly how the IRS is going to digest all this information according to what they're saying. It's not subject to automatic audit. But this is the part where we create great value for our clients, where we need to provide a good reason and persuasiveness here.
And Parag, let me approach this from a different angle, since many of the people watching this webcast are CPAs. As CPAs, we don't want to be the ones that are mentioned on these, listed as somebody who gave faulty advice. So it just underscores the importance of that we always be diligent in making sure that we are communicating with clients in writing the need to be fully transparent with their offshore assets, and not to imply to the client anything to the contrary. That there's really only one answer here, and that answer is that all income and all assets outside the U.S. must be disclosed.
Yeah, absolutely. Now, this is probably something for we could do a whole seminar on risk management in this context. And if you do, I tell all advisors that you really ought to notate in your file, either through an email to your client or at least an internal memo to yourself or in the file that you did advise the client that they had to report all their information, all their foreign information, and just say the date and the time that you did that. Therefore, you can protect yourself. And in terms of why the IRS is soliciting the professional advisors, they did that with the OVDP program. And I think what they're doing is they're creating a database, and if your name shows up enough, then you'll probably be contacted. It's usually often in the context of foreign bankers, but there are U.S.-based CPAs that have gotten to hot water in this context. there's some transition rules that are short-lived, only for the next several days for taxpayers currently in the OVDP. And I encourage you to read the transitional rules. They're FAQs at the IRS website, and you should search transition in their search box. Someone who's currently in the OVDP before July 1st, just next week, early next week, if they've already mailed the IRS Criminal Investigation Division your voluntary disclosure letter with all the attachments, which is quite long, by the way, then if you've already mailed it in, then you qualify for streamlining out, meaning you're in the OVDP and streamline out. Now, also people who have not received the Form 906, which is the closing agreement that you get in OVDPs, or a taxpayer that's opted out but still has not started an examination. An examination is where the examiner has written you a letter and often asks for some questions, in which case you'll know whether the examination starts. I have many cases like that, in which case you're not eligible to streamline out. But these are the people that qualify to streamline out of the OVDP. If you've just sent in a pre-certification and have received confirmation back from the IRS, then you may well advise your client to submit your voluntary disclosure letter, because then you're fully in the OVDP and you have the option of streamlining out. Now, what that means is if you have not pre-certified, maybe if you're in the OVDP, maybe you may not be able to get out, and that's one of the restrictions. If you're in OVDP after July 1st, and I know there's a little bit of gray area here whether you're formally in. Apparently, the IRS is telling taxpayers that if you haven't fully done all these things, then you're perhaps out of the OVDP. But before July 1st, these are the options that are available to you, and you should be very careful with clients that are in and explain all their options that are available to them before July 1st.
And just to kind of put this whole conversation in context, we're going to get to in a few slides what the differences are in terms of entering the Streamlined program fresh as a new applicant or transitioning into Streamlined from OVDP. And there are some differences. And that's why if, for whatever reason, your client believes they will be better off transitioning into Streamlined, these are important criteria for you. The other comment I'll add is the second bullet from the end. As of July 1st, 2014, Form 906 not fully executed. I have a client where we signed the 906, we paid the tax, and this was back in January or February, and it was almost kind of a forgotten event by now. But we never received the executed copy back from the IRS, because that can take a few months sometimes. And for that particular client, we're trying to transition to Streamlined because we have not received the executed copy back from the IRS. So we're hoping that we're in that window. So you may have clients that you think this is behind you, and there may be an opportunity.
Now, a client has submitted the OVDP pre-clearance as of July 1st, but not received a response. That's exactly what Vinay was talking about, where you're not formally in, probably. In which case you probably have an opportunity to streamline out. But that's a good question, and I know, Vinay, you and I have been grappling with this.
Right.
Good news is that we only have to deal with it for the next couple of days.
Correct. Okay. So we come to our second polling question. Under the Streamlined Domestic Offshore Procedures, the penalty imposed is A, 5% of the unreported financial assets, 5% of the unreported income, 27.5% of the unreported foreign financial assets, or D, 27.5% of the unreported foreign income. So please respond as soon as you can so we can move on with the presentation. Okay, so we have 80%. If I can encourage everybody to just vote. We'll just keep it open for another few, 20 seconds or so. Slowly getting there. And of course, the answer is A, 5% of the unreported foreign financial assets under the Streamlined Domestic Offshore Program. It used to be C, so huge difference. All right, Parag.
So what's the impact of transitional treatment? All the rules of the OVDP apply except the 27.5. So if you're able to streamline out, what that means is that you're going to get a 5% penalty instead of the 27.5, but this 8-year rule still applies. The best news is that you have closing agreement, so this is, you get confirmation from the IRS that this is a done deal. So there is some benefit to transitioning out of the out of the OVDP to Streamline.
So, let me just give an example. If my unreported asset was a brokerage account that was at the same asset level for the last 8 years, and it really generated very nominal income, I may not be paying very much significant additional tax by having an 8-year look-back period under OVDP than I would the 3- and 6-year look-back period under the Streamline. So in that case, if I was willing to put up with the intrusiveness of an OVDP procedure, maybe I would want to transition into Streamline from OVDP because I'll actually get a closing letter. For most people, however, there will be income in those earlier 5 years, and that may be a significant additional cost to pay. So those people, if they have the option, would not want to Streamline in. They would want to start OVDP fresh if they could. Now, if you've already got a pending application, that's kind of a moot point. You would Streamline in because that 27.5% is better than 5. Again, assuming that you had good facts. Parag?
So you obtain transitional treatment if you're in the OVDP by submitting all the required OVDP documents, and then you also have to provide this Streamline certification statement, which is this whole non-willfulness advocacy statement that you're signing with reasons. Pay the full amount of the tax and the penalty, and you send all your information directly to the examiner. If you don't have an examiner, you send it out to Austin, Texas. So that's basically how you get out of OVDP and Streamline out. Now, it's not automatic. If you're in it, you have to ask for it. If you don't ask for it, you're not going to get it. And of course, as part of this certification on non-willfulness, the examiner has to agree. So the bad news is that you actually have a human looking at this, a person that's named as opposed to a fresh Streamline. The good news is that you're in the program and you'll get the 906 letter out of it. But the examiner has to agree that there's non-willfulness, which in my experience, if your client truly is non-willful, most examiners will probably agree. But that, of course, is the whole, that's the most important part of this whole discussion.
So now we're going to switch gears and talk about the Streamlined foreign offshore procedures. And as we said before, domestic and foreign in this context really depends on where the taxpayer lives, not the source of the income. So in 2012, the IRS came out with what they called the Streamlined Filing Compliance Procedure. And the real thrust of that program was people, U.S. citizens and residents who had really been living and working overseas such that they were paying tax in the foreign country. The foreign tax credit basically offset any U.S. tax that was due, and they really weren't considered to be a threat or a high-risk taxpayer that was really trying to avoid U.S. taxes. The IRS had this procedure, and it was pretty restrictive, so you didn't see a lot of people taking advantage of it. You had to have owed less than $1,500 of tax with your U.S. tax return when you filed it, net of the foreign tax credit, and they had some other subjective criteria they looked at to categorize you either as a high risk or low risk. And if you were considered a low risk, then you basically just mailed in your returns with very little penalties. So what they've done is the IRS has revamped that program and made it much more streamlined and comparable to the domestic program, which Parag just talked about. So you first have to, how do you qualify for this? You have to meet the non-residency requirement. We're going to talk about that in a second. And you have to, very similar standards to the domestic policy, you have to have non-willful conduct, and the definition is the same. It's due to non-willful conduct as conduct that is due to negligence, inadvertence, or mistake, or conduct that is a result of a good faith misunderstanding of the requirements of the law. Okay, so again, it is a subjective argument. You do have to meet that criteria. So who qualifies? You have to look back at the 3 most recent tax years, and if you didn't maintain a U.S. abode and you were out of the U.S. for at least 330 days in a year, you're going to qualify. So that's a little bit like the test that we're used to for the foreign earned income tax exclusion under Section 911, the 330 days. But under that rule, whether you maintain a home in the U.S. or not doesn't matter. There are some rules that say that if you have a home available for you for temporary living purposes, or your own house that you rent out that you really can't go live there, that will not qualify as a U.S. abode. So therefore, you might be able to meet this test. So, I mean, for practical purposes, this is somebody who is really living and working outside the U.S. And that's kind of what I just said. There are different rules if you're not a U.S. citizen or green card holder, but those are a little bit too technical. We're going to skip that for purposes of this discussion. And that takes us to our third polling question. Which taxpayers get a closing letter Form 906 from the IRS? Number A, Streamlined Domestic Offshore Procedure participants. B, Offshore Voluntary Disclosure Program participants. C, both, or D, neither. So we will wait for a minute as people vote, and I see the votes tallying in. And so far it looks like people are paying attention because the right answer is in the lead. We'll wait just 10 or 15 more seconds to get some more votes in. And of course the answer is V. You get the closing letter when you're part of the OVDP, not under the streamlined process. So now let's go back to the discussion about the foreign offshore procedures. How do you apply? Well, you file your last 3 years worth of tax returns. You file your last 6 years worth of FBARs, and you pay the full amount of tax and interest due in connection with the filings. So if you were paying attention during Parag's session, what's missing here? Well, what's missing is the 5% miscellaneous offshore penalty. So the IRS is waiving that if you meet the streamlined foreign offshore procedures. So if you have a taxpayer that maybe has been migratory between the U.S. and a foreign country, maybe and there's some position that you can get them to fit into the foreign offshore procedures, it's definitely worth looking at because you do get the ability not to pay the 5%. You just pay the tax and the interest, and you're back in the fold. You do fill out some similar forms, but it's even easier than the domestic streamlined procedure if you qualify.
So Vinay, this really is a very good deal. If you have a taxpayer or client that's living outside of the United States that has non-compliant assets that has lots of evidence of non-willfulness, this is, there's no reason really not to do this. Would you agree? I
absolutely agree. Absolutely agree. And we see so many clients that will leave the U.S., go live in a foreign country, then move back. And so you could have a situation that you think is in the U.S. and maybe they've spent some significant amount of time in a foreign country recently, and maybe they would qualify. So it's worth exploring. All right. So now we're going to talk about the another leg to the new programs the IRS has put out, and they've called it Delinquent FBAR Submission Procedures. Now, under the Offshore Voluntary Disclosure Program before it changed on June 18th, there was a very important frequently asked question number 17 that basically said, what if I've always paid my income on my offshore assets, but I just never filed the FBAR? And OVDP FAQ 17 basically said, as long as you have a good faith reason, send in your FBAR, and we're not going to impose any penalties. And I'm paraphrasing. And so what the IRS has done is they basically carved out OVDP FAQ 17 and kind of made it a self-standing program. They haven't really changed the aspects of this policy, but in my own opinion, they've kind of given it some more weight. They've kind of formalized their policy that they're really not looking to beat up taxpayers who have not filed an FBAR who haven't done so due to an honest mistake, but they have been paying their tax. So that's why I think this is an important program. You can see the criteria on the screen. You haven't filed it, you're not under exam, you've not been contacted by the IRS, and very importantly, you've properly reported income on U.S. tax returns.
So this program always existed, though, right, Vinay?
It always existed as under the OVDP. So I forget. I mean, the first OVDP came out in 2009. I'm not sure exactly when FAQ 17 came about, but pretty soon after that.
It came out in 2011.
Okay.
So that means that really they just renamed this. Instead of FAQ 17, they just said, let's give it a nice name, Delinquent FBAR submission procedure. The most important takeaway is that you have to pay all your income taxes prior to doing this.
Correct. And this is a good time to mention that here we are on Friday, June 27th. Our FBARs are now due. The 2013 FBARs are due June 30th. There is no extension. They must be filed electronically. And the requirement to file an FBAR can be more than just a personal account somebody has. We have many people who have ownership in businesses, and those businesses may have either foreign accounts or those businesses may own subsidiaries that have foreign business bank accounts. And you would be amazed at how broad these FBAR disclosure requirements can be if you have a taxpayer in the U.S. that is a business owner. So I would encourage you to think about as you're filing FBARs in the last few days here. So now let's go to another aspect, which again is very similar to FAQ 17, and this was FAQ 18, which basically says, as I'm paraphrasing, what happens if I didn't file certain foreign information returns, but I always declared my income associated with those foreign assets? What do I do? And the IRS said, again, if you have reasonable cause, amend your return, mail them in, tell us your reasonable cause, we're not going to penalize you. So some of these forms, you've seen us throw around these form numbers a lot in these presentations. 5471 is the form that you're going to file if you're a U.S. owner of a foreign corporation. 5472 is the form you're going to file if you're a U.S. entity that's owned by a foreign party. 8938 is the specified foreign financial assets that have to be shown if you own different criteria based on your filing status, kind of the income tax equivalent to the FBAR. And then 3520 and 3520A, and that's a typo there, it should be 3520A, is relating to foreign trusts. All of these forms have very weighty penalties for not filing. Even though none of these forms, I don't think, have any tax due, maybe the 3520, but most of them don't have any tax due. They're disclosure forms only. So very important to focus on this.
What I see very often is a client that comes in and has received a large inheritance from abroad. In that case, the 3520, which is a foreign bequest from a foreign estate, is something that's required to be filed, and often it is not. And this is an opportunity to clean up the mess.
Exactly. And you know, there's a little bit of a quandary or interesting question, because when you come to talk about late FBARs, under the Bank Secrecy Act, there's there's a clear 6-year statute of limitations for how long the Treasury can come after you for late FBARs. When you come to these forms, there's actually some changes made in 2010 that keep the statute of limitations open, in theory, forever on a return after that 2010 enactment date if you don't file some of these forms. So it leads to an interesting question. If you realize that somebody should have been filing these forms since, say 2003, do you go back and file amended returns with these 5471s from 2003? And I think the theoretical answer is yes. I'm not sure if that's the practical answer or not, but it is something to keep in mind when you're trying to go back and clean up missed filings that may have been omitted for quite some time now. And how do you take advantage of this new procedure? You actually file amended returns. So in most cases, there'll be no changes to the numbers if you're filing a form 5471 and there's no additional dividend income to report from that foreign corporation. You will be filing them in a return, but there'll be no, that middle column of your tax return will not have any changes. And you attach the reasonable cause statement, and you certify that the foreign entity was not engaged in tax evasion. And you mail it in, and there should be no penalty imposed. Okay, so our last polling question is, which of the following is not an example of an international informational return? Form 5471, information return of U.S. persons with respect to certain foreign corporations. Form 5472, information return of a 25% owned U.S. corporation or foreign corporation engaged in the U.S. trade or business. That's a long form number, form title. Form W2, wage and tax statements, or Form 8865, return of U.S. persons with respect to certain foreign partnerships. So hopefully that's an easy question, and just waiting for everybody to click the button to vote. And I think we're just about there. And of course the answer is C, W2. The other forms are very common in the international reporting area. So now let's go back to OVDP, which before June 18th had really been our main avenue to assist clients. And what we do is we have some changes to OVDP. Effective August 4th, which is a new date that we haven't spoken about, the IRS has published a list of banks that are, I'm going to call it, on the bad list. And if you are reporting an account with a bank from the bad list, not your OVDP penalty will go from 27.5% to 50%. And right now, that list, I don't have the list in front of me. It's a relatively short list, but it has some of the banks that have been in the headlines recently. And one of the current concerns about anybody entering into OVDP is that you want to get your application in before your bank may show up on that list. So it is a little bit of a challenge, or another aspect to be considerate of when you're going into OVDP, this potential for a 50% penalty.
And by the way, most of these banks on this, right now it's a list of 10 banks. Most of the banks are rather small, with the exception of UBS, Credit Suisse. HSBC India is on that list, and most of the other banks are rather small banks. It's anticipated, however, that this list will grow significantly in the future.
Under OVDP, the 2012 OVDP, there was a reduced penalty structure. There were two categories, one where you could get a 12.5% penalty, one where you could get a 5% penalty if there were certain account balances was less than $75,000 and certain other criteria were met. So in light of the 5% offshore penalty under Streamlined, the IRS has taken that piece out. And so there is no more reduced penalty structure under former FAQs 52 and 53. The other aspect is that now if you're going to apply to OVDP, you have to submit a lot more information to Criminal Investigation Division of the IRS to get into the program. And the offshore penalty has to be paid at the time of submission. So under the program as it existed before June 18th, you would pay under OVDP the income tax and the interest and accuracy-related penalty, but you would not pay the offshore penalty, the 27.5%, until the time your case was pretty much wrapped up, which in some cases could be a year. Now you've got to pay that up front. And also, all account statements, regardless of size, have to be provided. In the past, I think it was just if your account balance was more than $500,000, it had to be provided. So go ahead.
It's becoming much more onerous for a client to go through OVDP. It's probably becoming more expensive if if one of their accounts is on this blacklist. And now the amount of disclosure that taxpayers provide is far more. For example, the account statements, if you have account statements which are very complex, it becomes a lot more work for us and a lot more onerous in terms of record keeping and record collection for the client. So really, I think what the IRS is perhaps doing is that they're channeling many of taxpayers that are willful into the OVDP program, and then the people that are not willful will probably streamline out.
So, Parag, we have a few minutes left. Let's just talk about what we do when a client comes to talk to us today. That says, I've got this account, I've not declared it, I've been reading all about the newspapers, my friends are telling me that I should be filing something called a FBAR. What do I do? What's your thought pattern, or how do you approach that scenario, Parag?
Well, I think now it becomes far more fact-based, based upon the client's circumstances. So, for example, Vinay, if you have a client that lives abroad that inherited, that's a U.S. citizen that inherited a fixed deposit, and they never acted on it, hasn't changed at all since inheritance from their parent, let's just say. Would that be a client that you'd recommend for OVDP? Probably not. I think,
yeah, probably streamlined.
Yeah, they probably would be an SFOP in that case. But if you twist the fact pattern more, Vinay, and if you say, all right, it's $1 million, it's inherited, and there's transfers back and forth, it's probably still non-willful, but again, this gets a little bit stickier, so then the slope gets slipperier in terms of whether there's non-willfulness or not. Vinay, what happens if you have that same client that has filed an FBAR once, and then they never filed again?
Yeah, so that's where it gets, that's another practical problem we run into. And the question is, why did that happen? Was it due to just sloppiness? And can I point to other indications of sloppiness in the taxpayer's financial world? And if I can make the case that it's sloppiness, then it doesn't bother me as much. But I think the presumption would be, well, you knew about it, so you can't argue you didn't know about the law. So it really is a bad fact against you to prove non-willfulness, because you filed it once. Why didn't you file it again? Was it that not important to you to make sure it got filed again? So that becomes much tougher to argue streamlined, I think, if you have that case.
And what happens if you have a client that is much larger? Let's go on the other end of the spectrum. You filed FBARs for 1 year, and you never filed again. You actively traded on the account, and let's just say it's a much larger number. Let's just say if it's $5 million, let's just say, and it's in Switzerland. What do you think you should do then?
Well, I'm going to look for more facts surrounding the tax firm. I'm going to look at their level of education, to what degree are they knowledgeable in tax and financial matters, were they using the money for personal purposes, things like that to try to build a case. But just the facts that you've laid out are all red flags. Active trading, Switzerland, not good facts. And I would be really concerned that people are going to, we have this streamlined program that you're just basically self-certifying that you were non-willful. And my concern is everybody's going to jump on the bandwagon and say, yeah, sure, I was non-willful, and it's very easy to argue against yourself. But when you have to really give some real thought as to was it willful, was it not willful, and if you really can't make that argument strongly, streamlined is probably not the opportunity for you. I think it's a false sense of security, and you should probably have a hard talk about with the tax about biting the bullet. And as long as you're, hopefully your bank is not on the bad list, and paying the 27.5% and really getting some closure to you. Go ahead.
As an advisor, I think that we have to basically explain what the streamline is, and probably read the certification to the client saying that, I understand the non-willful conduct is good faith and misunderstanding the requirements of the law, and you need to probably show them that you have to be willing to sign this as well as provide reasons for that. Now, if you have a domestic taxpayer that has a large amount of money, let's say $5 million abroad and only $1 million here, there's a concept of willful blindness, which the IRS has argued sometimes, with success, where how could you have been blind to that foreign balance? it was so large as opposed to your other balances, and you intentionally close your eyes. So the larger the amount of money, relatively speaking, I think is one factor. There are other factors. For example, if you used a foreign address or hold mail or use an entity, actively traded these accounts as opposed to passively trading on the accounts. This makes it much, much more slipperier. And I think as an advisor, it's important that we probably insulate ourselves from a malpractice lawsuit and say, we're giving you these options. You need to understand that there's risk with the streamline, that what you think is was non-willful could be construed and interpreted by the IRS as willful. And you may want to recommend that you're giving these two options and you really, the client is making a choice on their own. Or if you are recommending streamline, you have to be very careful of your risk management internally and make sure that you're able to handle that risk and document what you're telling the client and why you're making that recommendation.
Right, and maybe you have that part as your engagement letter that, if you're doing work to represent them on the streamlined program, that they understand that it's really their their representation of the facts, and you as the advisor not giving any guarantees.
I actually internally now have a certification that I'm having my own clients sign now saying, I've advised you of these facts. I've advised you of these options that are available to me. I understand I'm assuming when such and such risk, and I'm still doing so willfully in an informed manner, and I understand the risk, and that way they don't come back and scream at me or sue me in the future. And internally I keep that almost as protection, internal protection.
Right, right. So let's switch gears for a minute, Parag, and let's talk about quiet disclosure, because we haven't talked about that much. And pre-June 18th, that was actually a very important topic, and I'm sure it will be something people ask about. So when we say quiet disclosure, we're referring to treating an error in picking up foreign bank interest income or filing an FBAR no differently than any other tax mistake one might make. If I deducted too much in charitable contributions, I didn't include some consulting income I should have included. What's the remedy? Well, the remedy is you amend your tax return, you pay the tax, and in almost all the time, the IRS will never impose a penalty. They will take the money. They may bill you for some interest, but generally speaking, the IRS is happy that you've come to them with an amended return and are usually very generous. So people in the past who have taken the quiet disclosure route, their position is, I made a mistake, I want to correct it. It was a mistake due to an honest misunderstanding of the law. It is far too harsh for me to pay out 27.5% of my assets to correct this mistake. I'm willing to file amended returns, mail them in, and then if the IRS wants to come challenge me, I'm happy to make my case at that time why I shouldn't have to pay anything more than this penalty. So for many people with very strong non-willful fact patterns, this was something that, this was basically their decision. Do they go into OVDP, pay a large sum of money, give up a large share of their assets, but at the same time know they have closure with the IRS? Or do they go through the quiet disclosure? And in my experience, I'm sure it's many of yours' experience, a lot of that didn't necessarily come down to the amount of money involved or the facts. It came down to the taxpayer's tolerance for risk. Many clients just couldn't sleep at night knowing that they could do a quiet. Many clients were scared of doing a quiet disclosure for fear that they could go to the mailbox any day and get a letter from the IRS, because the IRS had gone on record as saying we don't like quiet disclosures. So many of those people in my practice went into OVDP. So now, Parag, now that we have this 5% penalty, how do you think that changes the dynamic between deciding between OVDP or Streamlined versus quiet disclosure?
I think that the number of quiet disclosures are going to drop significantly. Now, in terms of what we should be telling our clients as advisors, I think there's really no good reason to do a quiet disclosure. If you have a program that is low or no penalty, then the reason to do a quiet disclosure is really no longer there. And most of our clients, even those with who can tolerate some risk, should probably be doing these streamlines. There is a program available for these non-compliant taxpayers. It has a name on it, SFOP, SDOP. These are the programs that these taxpayers should be using. I think the risk of discovery and a quiet disclosure and not taking advantage of these programs, especially for a non-willful taxpayer, you don't need to do that anymore. So I think the number of streamlined applications are going to increase dramatically. I mean, there are going to be a lot of people that take advantage of this program just because it's, frankly, it's a great program compared to OVDP. So it's, and I think the IRS knows it. So there's going to be a lot more money coming in, a lot more work to be done for all of us in this area.
Agreed. Parag, we have a handful of questions. Most of them are pretty fact-specific, so I don't know that I'm going to address most of them, but there are one or two that I'm going to address. One is, scroll down. Okay, please clarify, it is 27.5% of the highest balance from the number of years balance under OBDI compared to 5% on the highest balance of each year under SDOP. So let me give you my response, and Parag, you can elaborate. Under OBDP, you look back on, you have an 8-year look-back period, and you look at your highest balance of foreign financial assets, and the highest balance in any of the 8 years, you pick that year, and you pay 27.5% as your offshore penalty. Under the streamlined domestic offshore procedures, what you're doing is it's actually a little bit a tongue twister. You look at your year-end balances for every year that would have been reported on an FBAR, and you look at those year-end balances for the last 6 years, and you pick the highest of those of that 6-year column, and that becomes subject to the 5%. That, I think, is going to be where most of the people pay their 5%. There are two other aspects to compute the 5% penalty. One is if you have assets that should have been reported on a Form 8938 but weren't, that gets included in the 5% penalty base. Or if you have an asset that was included in the FBAR, properly, that should have been on the FBAR in the 8938, and you reported it that way, but you didn't include the income on your income tax return. So you had a stock worth $500,000 and it paid a $100 dividend, you didn't include the dividend, then that asset goes into the calculation. So it's really 3 different calculations to calculate the 5%, but I think in most cases it will be the highest year-end FBAR balance for the last 6 years. Parag, does that make sense to you?
Yeah, that's correct.
Okay. One other, I think, really good question is, if a taxpayer plans to go into Streamlined as of June 27th, does the taxpayer still need to file an FBAR before 2013, before 6/30/2013, or could it be filed with the other 5 years without getting exposed to any late FBAR filing penalty? So this is just my opinion. There's no hard and fast answer. But I'm a believer that you should never let a due date go by if you can avoid it, and you should never file late if you can avoid it. So I have a number of clients in this situation where we're going to be doing Streamline. We don't have everything ready to go back for the 6 years of FBARs, so we're filing the 2013 FBAR on time. And right now you have to file FBARs electronically. What I do is there's a space for filing late, and I write a note that says the effect that this return is not being filed late. However, the taxpayer recently became aware that they have an FBAR filing requirement for prior years, and they plan to be filing the previous 6 years FBARs pursuant to the Streamlined program, and they'll be doing that within 4 weeks or something like that, because I want to go on record to the IRS before they come to me that we know we've missed some filings and we're on top of it. So I'm not an advocate of waiting and missing the 2013 FBAR deadline and filing everything at one point.
I have a different perspective on that. I had a client that basically came to me with a similar fact pattern, in which case they also told me that 2010 was the year they did not want to amend, which means that I told them that let 2013 be a non-compliant year. So you're not filing your FBAR timely, in which case you're going through Streamlined with 13, 12, and 11. In which case that you're really, the question is which 3-year period are you amending for the Streamlined. And if you have some reason that you don't want to amend 2010, then you want to not file an FBAR timely. But that's really the crux of the issue, is which years are part of your penalty period.
All right. So we are out of time. There are a number of specific questions that we got. Parag and I will try to respond to those people individually. We thank you very much for joining us today. Please be on the lookout for the CPE evaluation forms. If you don't get it, please contact me. You see my email address on the screen. And again, thank you very much. And Parag and I look forward to any questions that you may have. Feel free to call us at any time.